The knife had certainly fallen very fast, and you always want to be careful about jumping in and falling that, catching that falling knife before it really bounces off the floor a little bit. But I think the price action we've seen is, I don't want to say textbook, but it feels good, right? We'll probably generally what I'd like to do is see it rally a little bit and then to go back again and test these levels, and then you get you look at some of the other cross asset signals, for example, the yield curve starting to de-invert. And I'm also looking at some stability in the Treasury yield curve to start maybe getting tamped down again, to sort of give that sense that, bond rates are not just going to the moon overnight, which I don't think they are. But that's going to give some comfort, I think, that yes, we can go ahead there. And of course, the elephant in the room is earnings, which are just around the corner.
Dan Wantrobski, one of the things I hear often when we talk about, these, is the bottom in? Are these points clear? Is this the all clear signal? Is that bottoms are processes and not just points on a chart. So from a strategy perspective, is this bottoming process more in the early stages, or perhaps one that we can say, hey, this is a time to get back in the markets?
Yeah, that's a good question. I tend to go with the theory that bottoms or correction cycles it's a process, and I'm not convinced that with the last 2 days we necessarily saw a bottom here. I agree that the markets come into this morning very oversold. You can see overseas markets were oversold and are rallying, so we'll catch a bid here. But typically, at least over the last several years, the bottoming process in U.S. markets, when you want to see capitulation like this, it almost comes in 2 or 3 stages, and it can be very rapid. But I think we've seen our first wave down. You're going to get some recovery. You can get a very sharp rally, even push close to the recent highs, take another leg down, and then possibly even a third leg down. Now, the key there is that with each successive leg down from here, and again, it can be a span of days or weeks, you're going to see selling pressure continue to dry up with each leg down. And that's what we would consider a positive divergence. It means that the cycle is exhausting itself. We're exhausting the sellers. So again, I'm not convinced that we necessarily have seen the bottom. I would agree with most folks that the markets are probably due a snapback rally, but we could see more pressure here. I mean, obviously longer term, we align with a lot of other folks out there thinking the markets are in good shape. We're in a secular bull market. In the U.S., the economy is strong, and we're seeing an expansion cycle here. But obviously, these corrections can always hit. Bull markets are notorious for these types of volatile periods, even passive bull markets. And so I think, what we're telling investors is, hey, of course, watch for some snapback rally, watch for some relief here, but let's still be a little bit cautious. We may get in actually at better levels, either in the days or weeks ahead.
All right, so Dan, that's his strategy. Michael, what's yours? This is your job. You're going to advise clients today about how they should either be deploying money, not deploying money, using different types of derivative instruments, maybe different strategies. What exactly are you telling them is the playbook for the coming days and weeks? Yeah,
so my playbook right now is look, I don't think you have to do anything just today. You can certainly nibble on some stuff here, but I think what Dan was just saying is that this is a process that can unfold over a longer time period. I think in this particular case, it's going to be a pretty short time period. And there's a few reasons why I say that. One, I think the earnings are likely to come in strong here, right? The economic data that we had since Q2 has really been really strong here. And so I don't see any reason why to think that this season from a top-down level is going to be particularly bad here. I'd also point out that if you looked at valuations, whether you're looking at the FANG index, whether you're looking at the Russell, the SPX or the Dow, it's actually right now, it's lower than it was during the worst part of the spring, during that volatility. And I think that's so the whole argument that the markets are priced to perfection. Well, I don't think they were a week ago or 3 weeks ago, but they're certainly a lot more attractive right now. And I think so. Here we are. If we do rally into, let's say we're up 2 or 3 points, and maybe it's just one of these glorified relief rallies. But if we're all of a sudden having this conversation around, the end of October, early November, the market's up 5, 6, 7%, well, then you have a lot of people who are still behind their benchmarks, and that sort of seasonal beta chase comes in. So I think there's usually it's never a V, straight to fresh highs, but I think this condition is going to be a faster recovery than what we saw unfold last February and March.
Dan, last word to you, just a couple moments left here. What would go on your shopping list if this process bottoms out and we start to turn higher again?
Ooh, well, that's a number of things. I mean, we like healthcare here, and not healthcare just as a defensive. I understand that it's working very well, but there is growth in the broader healthcare sector. That would be anything from, gene therapy, biotechnology, life sciences, bioproduction. We would also look to consumer discretionary. We would look to industrials, which have been acting very well. And finally, financials. I've been a holdout. I've been rooting for financials and banks for quite some time. But I do think that with the 10-year finally breaking above 310, I think yields are going to continue to press higher, not necessarily over the short run, but on a longer-term basis. And I think that can drag financials and banks higher. Remember, banks are a pretty big component of the S&P 500, so if they start to do well, they could do some heavy lifting in the broader benchmark. So I would add financials to that list as well.